Hello everybody, this is James Romelli from AlphaSharkTrading.com, and I want to talk to you guys a little bit about why I choose to trade spreads ahead of earnings instead of outright options. So we're going to talk about some of my favorite strategies to trade on earnings. So CTSH has earnings tomorrow morning, and this is one that I traded, and I actually traded CTSH by buying call spreads. Now, why did I choose to buy a call spread rather than outright calls in CTSH if I think the stock's going higher? Well, there's a lot of reasons for that, but the number one reason, and also the source of the number one pitfall for rookie earnings traders, is that volatility crush will hurt any long premium positions that I have on. So you might have found yourself in a situation in the past where you've been long calls, seen a stock go higher, but your calls are down in value. Well, this happens because of implied volatility, and no time is this effect more pronounced than before and after earnings. Going into earnings, we see a huge bid higher in implied volatility, and the prices of options in stocks that are about to report earnings become more expensive. This is because earnings creates uncertainty. All that uncertainty brings more demand in for options. After the event happens and earnings come out, the uncertainty is gone. Tomorrow, when we come in here, we'll have their earnings, we'll have their revenues, we'll get to see what they said on the conference call, we'll have all this information that we didn't previously have, and the stock's going to move a lot. The stock's going to move a lot, and all of the traders that were involved in the name ahead of the earnings are going to start getting out of their positions. The hedgers will get out, the speculators will get out, implied volatility will come crashing down. So even if the stock does gap higher, if I'm just long outright calls, I might not see as much of a return as I would if I was using a spread. The spread also allows me to have a much better and more well-defined risk versus reward ratio, because the amount of money that I am risking in a spread is going to be much less than the outright option. Why is that? Because I'm selling one call against a call that I'm buying rather than just being outright long. Also, that short call helps me negate some of that negative effect of the drop in implied volatility. If I was just long options, that would hurt my position a whole lot more. All right, so keep an eye out tomorrow. I'm going to show you guys more about our earnings trading plan, and in particular, in tomorrow's video, we'll be talking about our number one and most favorite tool that we use for trading earnings, called Earnings Hacker, where you can get all this information in one place. So please check out the video tomorrow, and thank you guys very much. And as always, happy trading. Thanks, everybody.